Um, the first way to invest in gold and silver miners is ETFs. Um, this is the easiest way to invest because ETFs act just like a stock, so they're easy to buy and sell. The premiums are generally pretty low. It's usually like 0.5% a year, sometimes less than that, 0.25% a year. Plus, the ETFs are managed, so they're professionally managed and reduces the risk because it's a basket of stocks and they have low allocations. It's a lot like a mutual fund, although mutual funds get valued only once a day, whereas ETFs value throughout the day. Plus ETFs, you can short them, you can do options on them, which you can't do with mutual funds. So we have GDX, which is the large cap ETF. Um, I forget how many, there's like 30 or 40 stocks, maybe more in GDX. And there's not very many that are, say, under 500 million market caps. Most of them are over 1 billion. So it's basically large caps. There's some royalty companies in there. There's not very many silver miners. I know the large silver miners like Pan American's in there, Heckler's in there, Coors in there, but there's not a lot of silver stocks. It's heavily weighted towards gold. GDXJ used to be, when it first came out, had a lot of juniors stocks in there, say 100 million, 200 million, 300 million. Now those are becoming pretty rare. GDXJ had a problem in 2016 and it dropped, I forget how much, around 15%, very short period of time, because they had to sell a bunch of shares because they owned more than 10%, because it basically got really popular in 2016 when the price of gold went up. So now it's very similar to GDX. They're both mainly large cap. There's two other ETFs, GOEX and GOAU, that are more towards the mid caps. And GOAU has a lot of royalty as well, but not as many majors. So those are kind of your four gold. And there's some more. There's some Sprott Asset Management has one. There's a few other ETFs for gold miners. And then silver, the two main ones is, actually, I'm not sure if Sprott has a silver one or not, or can't really think of a third one. It's kind of popular. Probably is another one out there. SIL, these all trade in the U.S., so I'm not sure if they trade internationally. SIL is more, it has more large caps than SILJ. SILJ is kind of juniors. SILJ outperforms SIL because it pretty much has all of the silver miners in it, whereas SIL focuses mainly on the producers in the larger exploration plays and the larger development plays. I think both of these, since there's not that many silver producers out there, they kind of both make sense. So you can look and see what the differences is. Okay, if you pick your own stocks, these funds can be difficult to outperform. So, these are basically a basket. It's kind of like an index. But the one thing is they have risk. I mean, if you're going to have high allocations in these, you never know. Whereas if you pick your own, if you create your own ETF, basically your own portfolio, you have more control over it. Whereas they, let's say you pick 20 silver mining stocks, you might not outperform SILJ, but you have more control over it. And so it's I don't like to have just a huge allocation in these. I'd rather kind of create my own portfolio and then add these into it as well to create a little bit of diversification. I think these all make sense for diversification. So you can have, because the risk reward on the ETFs is pretty good, but it's not fantastic. Benefits, they trade just like a stock, which I mentioned. Lower risk than individual stocks, but maybe not necessarily lower risk than a portfolio. They have low fees, 0.5, 0.3, 0.25, so it depends. Low premiums, and they're very liquid. Drawbacks. Not every country, depending where you're at, will have access to these ETFs. Some, I mentioned the large position, some investors don't like to have large positions in a particular ETF. So that makes it hard if you're only going to do ETFs. You have to pay annual fees, but they're usually low. And you don't notice it. It's just the value of the stock will drop when they take the fees out. But it's with ETFs, it's not really that noticeable. But over, if you hold it for 10 years, maybe it can be an issue. Some people don't like ETFs for that reason. You only have a limited number to pick from. There's not a lot of choices out there. They might not meet your investments, and the dividends tend to be low. If you really don't buy ETFs for income per se, you really want to go more with the mutual funds, which we'll talk about those.